Okay, let's dive right into this explainer. If you follow the financial markets, earnings season can sometimes feel like a barrage of dry numbers. But every now and then, a financial report drops and it reads less like a spreadsheet and way more like a detective novel. That is exactly what we've got today. We're going to look past the shiny headlines, dig into the actual auditor reports, and figure out what is really happening under the hood of Amara Raja Energy and Mobility.
We're skipping the pleasantries today and starting with a massive headline figure right out of their Q4 report, a staggering 93% jump in net profit. For the quarter ended March 26, they posted a net profit of 322 crore rupees. That's nearly double what they did previously. In the manufacturing sector, where growth is usually, steady and incremental, a near 100% jump in a single quarter is the kind of number that makes investors instantly sit up, take notice, and honestly, usually start buying.
But here's where things get kind of weird. The paradox here is just striking. On one hand, the company announced sales of 3,460 crore rupees for the quarter. That's a very respectable, solid 16% increase in sales. But think about it. How does a company nearly double its profit, a 93% jump, remember, with only a modest 16% rise in the actual goods they sold? Usually, to double your profit, you either got to sell vastly more products or you need to drastically slash costs to widen your margins. Before we crack that mathematical riddle, let's take a quick second to look at the company itself, Amara Raja Energy and Mobility. Now, you probably know them better by their incredibly popular consumer brand, Amara batteries. They're an absolute heavyweight in the energy storage sector, powering everything from your everyday passenger car to massive industrial applications. So let's be real, this isn't some volatile tech startup. We're talking about a heavy-duty, capital-intensive manufacturing business, which makes our profit mystery all the more intriguing. To deepen the mystery even further, operational efficiency absolutely did not cause this profit spike. In fact, operating margins actually dropped slightly, going from 11.50% down to 10.90%. So their core business, actually making and selling batteries, became slightly less profitable on a per-unit basis this quarter. That's likely due to the cost of materials consumed or other operational expenses creeping up.
Right? So we are left with a pretty glaring question. If the core business margins actually contracted and sales only grew by 16%, where on earth did all this extra cash suddenly come from? To find out, we have to look away from the standard profit and loss columns and do what any good financial detective does. We gotta read the fine print.
Let's head over to the footnotes of the auditor's report, because man, does this build a completely different picture. Right there, buried in the text from the independent auditors, is a tiny section labeled Note 4B, Exceptional Items. Now, if you know accounting, you know exceptional items is basically the bucket where companies toss one-time non-recurring financial events, just so they don't distort the view of everyday normal business operations. And boom, right there is our smoking gun. Note 4B reveals the company received a massive insurance payout of 186.72 crore rupees. It turns out this was a full and final settlement for a fire accident at their manufacturing facility in Chittor, way back in January 2023. Because this huge lump sum of cash was finalized and recognized in this specific quarter, it completely artificially inflated the bottom line. So that 93% profit jump? Yeah, it wasn't a sudden explosion in battery sales. It was literally an insurance check clearing the bank. Okay, so if we zoom out from that one-time anomaly and look at the full year, things start to make a bit more sense. We actually see very solid, fundamental top-line revenue growth for FY26. Total sales climbed from 12,405 crore rupees to 13,549 crore. That tells us that underneath all the noise of that insurance payout, the actual underlying business of selling energy products is growing at a really healthy, sustainable pace. But wait. When we look at the full-year net profits, that's where we see the company's real trajectory. They were basically flat, just a tiny bump from 964 crore to 970 crore. That right there shows you just how wildly that one-time insurance payout skewed the Q4 headlines. In fact, over a 3-year period, the company's net profits basically have a compound annual growth rate of 0%. So profit growth has essentially stalled out, even as revenues have been steadily climbing. But hey, it's not all flat lines. Here is where the company absolutely shines, and it's a metric every serious investor loves to see. Their free cash flow to operating profit ratio is over 100%, 106% to be exact. So what does that actually mean? It means they are incredibly good at converting paper profits into actual cold, hard cash in the bank. You know, a lot of companies show profit on a statement, but the cash is all tied up in inventory. Amara, on the other hand, generated 588 crore in free cash flow from operations. That proves their earnings are exceptionally high quality. And all that cash generation? It translates into a rock-solid fortress of a balance sheet. They're sitting on a massive mountain of reserves, 8,142 crore rupees, compared to a tiny debt load of just 373 crore. That gives them immense financial flexibility. They aren't bogged down by interest payments, which means they can easily weather economic downturns, or even better, aggressively invest in new tech like advanced cells without breaking a sweat. Now, if you're a shareholder tuning in, you're probably wondering what this means for your wallet. Well, that strong cash position means the company rewarded investors with a two-step dividend payout this fiscal year. They did an interim dividend of 5.40 rupees per share back in November, and now the board has recommended a final dividend of 5.20 rupees. That brings the whole shebang to 10.60 rupees per share. That is a very solid 20% dividend payout ratio. So who is actually collecting those dividends? It's a pretty encouraging mix for retail investors. The core promoters hold just under 33% of the company. But look at the institutional backing. Foreign institutional investors hold over 17%, and domestic institutional investors are right there with almost 17% too. When the smart money, the large mutual funds and foreign institutions own over a third of a company, it's a huge signal of confidence in their governance and long-term viability. Just returning to fundamental efficiency for a second, the company generates a very healthy 13.5% return on capital employed, alongside a 10% return on equity. This just goes to show that management really knows how to use the capital they have. It's a classic hallmark of a mature, well-run manufacturing business that knows exactly how to squeeze value out of its factories and supply chains. Yet, here is the final plot twist in our investigation. In stark contrast to their rock-solid cash flows, massive reserves, and those consistent dividends, the stock has actually fallen 12% over the past year. Now, if you've been in the market a while, you know fundamentals and stock prices can sometimes completely detach from each other. Despite the company being fundamentally sound, the market has really punished the stock. Which leaves us with a fascinating final question to ponder. Is the market completely missing out on the fundamental cash-generating strength and fortress balance sheet of this company, or are investors actually making the right call by staying away because they see that long-term profit growth has flatlined, despite that flashy Q4 headline? It is the ultimate value investing dilemma, and honestly, it's a perfect reminder to always read the footnotes. Thanks for joining me for this explainer, and keep questioning those numbers.